What if I told you that Warren Buffett, the man worth over $100 billion, built his entire fortune using one idea so simple, you could explain it to a 10-year-old in 60 seconds? No options trading. No crypto. No day trading on your phone at 2 a.m. Just one principle. Repeated. For 70 years. It's called value investing, and by the end of this video, you'll understand it better than 95% of people on Wall Street. Let's go. Welcome back to the channel. If you're new here, we break down the world's greatest wealth-building ideas. No jargon, no fluff, just the real stuff. Today we're going deep on value investing, what it actually is, where it came from, and most importantly, how Warren Buffett uses it in plain English. I'm going to walk you through 4 things. What value investing means. The simple grocery store analogy Buffett himself uses. The 2 numbers that matter most. And the one mental shift that separates investors from gamblers. Stay till the end, because the last part is the thing most people never hear. Okay. Let's start from zero. When most people think about investing, they think about price. A stock goes up, you're happy. A stock goes down, you panic. That's it. That's the whole game for most retail investors. But Warren Buffett doesn't think in prices. He thinks in value. And here's the difference. Price is what you pay. Value is what you get. Buffett learned this from his mentor, a Columbia University professor named Benjamin Graham, who literally wrote the book on this. The book is called The Intelligent Investor, published in 1949. Buffett has called it, by far the best book on investing ever written. Graham's core idea was this: the stock market is not a precise machine. It's an emotional, irrational, moody creature. Some days it overvalues companies. Some days it undervalues them. And if you're patient and disciplined, you can take advantage of that. That's value investing in one sentence. Find great companies being sold for less than they're actually worth, and buy them. Simple. Obvious even. But almost nobody actually does it. Here's how Buffett explains it. And I love this because it's so real. Imagine you go to a grocery store every week to buy orange juice. You know, you've bought it 100 times, that the orange juice is worth about $3 a carton. That's the fair price. That's the value. Now one week, you walk in, and the store has it on sale. $1.50 a carton. Same juice. Same quality. Just a sale. Do you panic and walk out thinking, "Oh no, the price dropped, something must be wrong with the orange juice"? No. You buy 10 cartons. Because you know what it's worth. But flip the scenario. Next month, there's a shortage. Everyone's buying orange juice. Now the store is charging $6 a carton. Do you buy it then? Probably not. You're overpaying. That's value investing. Know what something is worth. Buy it when it's on sale. Never buy it when it's overpriced just because everyone else is excited. Buffett once said, and this is one of my favorite quotes from him, "Be fearful when others are greedy, and greedy when others are fearful." That's not just a clever saying. That is the strategy. When the market panics and stocks fall, that's often when Buffett is buying. When markets are euphoric and everyone's throwing money at anything, he sits on his hands. Now let's get a little more specific without getting complicated. If value investing is about finding companies worth more than they cost, how do you actually figure out what a company is worth? Buffett focuses on 2 core ideas. Number 1, intrinsic value. Intrinsic value is the real, underlying worth of a business, based on how much cash it will generate over its lifetime. Think of it like this. If someone offers to sell you a vending machine, you wouldn't just look at the machine. You'd ask, how much money does this machine make every year? How long will it keep running? What are the costs? Once you know those numbers, you can figure out what the machine is actually worth to you. That's intrinsic value. For stocks, Buffett does the same thing for entire companies. He estimates how much cash the business will produce over the next 10, 20, 30 years, and then calculates what all of that future cash is worth today. When the stock price is lower than that number? That's your buying opportunity. Number 2, the margin of safety. This is Graham's genius idea, and Buffett swears by it. Even the best analysts make mistakes. The future is uncertain. Companies hit unexpected problems. So instead of buying a company at exactly what you think it's worth, you demand a discount. If you think a company is worth $100 per share, you only buy at $70 or less. That $30 gap is your margin of safety. It protects you from your own mistakes. Buffett puts it this way: you don't need to know a man weighs exactly 300 pounds to know he's fat. You just need to be reasonably sure the price is well below value. The exact number doesn't need to be perfect. This is why value investors almost never rush. They wait. And wait. Until the margin of safety is big enough. So we know the philosophy. But what does Buffett actually look for in a company? He's talked about this publicly many times, and it comes down to 4 things. 1. A business he understands. Buffett calls this his circle of competence. He won't invest in something he can't wrap his head around. If you can't explain what the company does and how it makes money in 2 sentences, he's not interested. This is why he famously avoided tech stocks in the 90s during the dot-com boom. He said he just didn't understand them well enough. 2. A durable competitive advantage. Buffett calls this a moat, like a moat around a castle. It's what protects a business from competition. Think Coca-Cola's brand. Think Apple's ecosystem. Think See's Candy's loyal customers. These businesses have something that's very hard to copy, which means they can keep earning money for decades. 3. Honest and capable management. He's investing in people, not just spreadsheets. He looks for managers who think like owners, who are straight with shareholders, don't waste money, and make smart long-term decisions. 4. A sensible price. And here's where it all comes together. Even if a business is incredible, if you overpay, you'll get mediocre returns. Buffett won't buy a great company at a crazy price. He waits. He's described his ideal investment as a wonderful company at a fair price, rather than a fair company at a wonderful price. Okay, this is the part 1 promised you at the start. The thing most people never hear. Value investing is not really about math. It's about psychology. The hardest part isn't calculating intrinsic value. The hardest part is doing the opposite of what every instinct in your body is screaming at you to do. When markets are crashing, your brain says, "Sell, get out, save yourself." The value investor says, "This is the sale I've been waiting for." When markets are booming and your neighbor is doubling his money on meme stocks, your brain says, "I'm missing out, get in now." The value investor says, "I see no margin of safety. I'll pass." Buffett has talked about this his whole career. He said the stock market is designed to transfer money from the impatient to the patient. Think about that. The market, this enormous, complex, trillion-dollar machine, ultimately rewards one thing above all else: patience. That's it. Buy quality companies at fair or discounted prices. Hold them. Let the business grow. Don't panic when prices fall. Don't get greedy when prices spike. Boring? Maybe. But it's the strategy that created one of the greatest fortunes in human history. So let's bring it all together. Value investing is the practice of buying great businesses for less than they're actually worth, and holding them long enough for the market to recognize that value. It came from Benjamin Graham. It was mastered by Warren Buffett. And the core ideas are available to anyone willing to learn them. You don't need a Bloomberg terminal. You don't need a finance degree. You need patience, discipline, and the ability to think for yourself when everyone else is panicking or celebrating. If this video helped you, hit that like button, it genuinely helps this channel grow. And if you want to go deeper, I've got videos on how to calculate intrinsic value, how to read a balance sheet like Buffett, and the top 5 books that made Warren Buffett who he is. I'll link them all in the description. Subscribe if you haven't. We drop new videos every week. And remember what Buffett always says: The best investment you can make is in yourself. See you in the next one.